Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. Today, my guest is Winnie Cisar. She is Global Head of Credit Strategy at CreditSights, and she's going to help me make sense of the corporate credit market and what investors should understand. Welcome, Winnie.
Thank you, Ed. I'm so excited to be here.
I'm excited as well. Also a little nervous because fixed income is not my first area of expertise, if you will. So I might fumble through a few terms, but bear with me. We'll try to get the good meat out of this for investors. You know, as I talk to folks around the firm and we explored the topic of fixed income, one thing keeps coming up. And I know you've had a lot of discussions about this, so you could probably rattle off a few things off the top of your head, but it's this idea that bond yields, and here I guess I'm just talking generally, yields are as high as they've been since the great financial crisis, but spreads are super low. So it's been great over the last couple of years to be a bond investor if you're just getting into it to capture some of the yields, but should I be concerned about where spread levels are?
This is the question that keeps coming up with investors. And right now there's a major game of tug of war going on between the people in credit who are traditionally spread buyers. They look at credit because it will perform relative to other fixed income products like treasuries where there is no spread. And then the yield buyers who just say, hey, US investment grade at 5.5%, 6% feels like a home run, especially compared to the past 10 years or so. And the big issue with fixed income is you have a massive universe of different types of investors who all have different mandates. Some are focused just on super high quality, long dated bonds, don't really care about spreads because they are constantly getting money in the door that they need to put to work. And so then long end spreads are even more tight than kind of the aggregate market overall. And then you have more of the say tourist investors who are just looking for good opportunities in kind of the short term, who are a little bit more focused on spreads. And then the true fundamental asset managers who are trying to actively outperform a benchmark index. And that's where spread really comes into play. And you have all of these different cohorts kind of fighting each other to figure out who's going to ultimately prevail in that valuation battle.
That's a really interesting thing to keep in mind. Sometimes we just talk very generally about it, but understanding there are different cohorts in the bond markets and different needs there. Are retirees and just people living off income, are they tourists, or is that a different category of investors?
I think it depends. I think that there is definitely a structural bid for corporate credit from pension funds, from 401k funds, from a lot of the kind of lifestyle actively managed target funds where, say, I plan to retire in 2034 and I want to be constantly rebalancing my portfolio across equities, credit, fixed income more broadly to ensure that I have the right mix of growth opportunities and also income generation opportunities. So I would say in general, the kind of retirement cohort, the people who are trying to save for a rainy day and have an income there, they're definitely not tourists, but there's different levels of investing from some of those cohorts, depending on what the market is doing, right? If yields are super, super low, not a lot of income generation opportunity, then perhaps you want to notch up or go into dividend stocks where you have both the potential upside from price appreciation, but you're also getting that income from a dividend.
Let's just talk about what a spread is, just for those investors that might be listening that don't totally understand what we're talking about. We're basically talking about the premium yield over another sovereign issue. Is that right? Maybe you have a better definition.
That's exactly it. So in the credit markets, the spread is the difference between the prevailing treasury rates if you're looking at US credit. So if you have a 10-year bond issued by Apple, everyone knows about Apple. It's a pretty big company. They have a lot of credit market debt outstanding. And those bonds are yielding, let's say, 5%. The 10-year treasury is yielding 4.5%. Then your spread is 50 basis points. And that's the extra compensation that an investor says, hey, you are not the US government. You have the great earnings of Apple, but what happens if iPhone sales are not as strong? I want a little extra something just to make sure that I'm being compensated for that extra risk that I'm taking on by going into an individual company and not the US government.
Is it weird then that spread today is so tight? I mean, I guess generally, what is it? Something like 90 basis points as we speak in June of 2024 relative to treasuries?
Right. So we have come a long way, and spreads are very tight on kind of a historic basis in aggregate, and also very tight relative to, I think, where people thought we were going to be when the Fed started hiking interest rates. And usually spreads tighten in periods of good economic performance. If you have earnings growth, if you have the expectation that there's not going to be a recession in the near term, then people feel more comfortable saying, hey, I actually feel like that extra 50 to 100 basis points of spread that I'm getting by going into the investment grade market is worthwhile, relative to just saying, I want to be super defensive, I only want to be in treasuries, or I want to just sit in money market funds and have a lot of cash. And so usually when you see strong economic performance and expectations for continued strong economic performance, that's when spreads get really tight. And now you have the additional impact of elevated base rates. And so unlike in the post-GFC era, where we had very low treasury yields compared to today, and spreads were a little bit wider because investors were not super excited about, oh, here's a 2.5% yielding bond. That's not going to get them super excited to put cash to work unless they feel like, oh, but I'm actually getting paid another 150 basis points relative to the underlying treasury rates. And so these elevated yields have actually been one of the reasons that spreads have become so tight, although I think it's surprised a lot of people over the past couple of years, given that no one thought that we could handle higher rates and the economy trundled along pretty well.
It keeps going. Is it going to end?
I would love to know that. If I did, I would probably be on a beach somewhere having set all my bets. I don't think it's going to end in a hard landing, liquidity-fueled blow-up. That's always a risk on the horizon. And, one of the downfalls of being a credit person is we're always looking at the downside. Unlike equity people who are always looking at the unlimited upside, we're always trying to figure out where can things go wrong and how much am I going to lose? Am I going to get repaid back at par? And I think that right now there's definitely a deceleration happening, especially on the consumer side of things. And that will probably result in some more disinflationary forces on the services side of things. And the big question is, can we calibrate monetary policy to kind of thread the needle between a still humming economy with the reality that people are probably not spending quite as much as they were over the past couple of years?
What has been the impact of the more recent issuance? And there's been kind of a bout of new issuance, hasn't there been?
There has been more than a bout of new issuance. There has been a staggering amount of new issue, which at the beginning of the year, everyone was kind of expecting. You had this perfect storm of Treasury market yields fell quite significantly in November and December. Then Powell came out with a very dovish pivot. There was a lot of risk sentiment that was then kind of thrown back into the market. And then you also have just the seasonal reality of companies tend to try to do a bulk of their issuance in the first quarter of the year. That's usually when asset managers and investors are setting themselves up to make money for the following year. And the new issue market is the best way to get access to buying a lot of bonds, kind of creating a new stake in a company. And the surprising thing is that we've had this very virtuous cycle of very healthy issuance to start the year that was very well absorbed by the market. We always say that supply follows demand, and demand for fixed income has been amazing this year, especially U.S. investment grade and also the leveraged finance markets as well, as people have gotten less concerned about a recession, a little bit more confidence in the ability to continue to generate earnings, even with higher policy rates. And so that has just continued to bring issuers off the sidelines because they say, hey, look at my peer company. They just priced a massive deal at record tight spreads. That's great at execution. I want to do that too. And so then they come to market. And now we've also had enough time where a lot of management teams and treasurers and boards are saying there's only so much we can do to manage the underlying treasury rate. And if we want to issue debt, if we want to buy another company or do some massive capital spending, then we need to bring a bond deal. And right now, execution from a spread perspective is really good. So we're going to go ahead and do that. And so the amount of issuance that we've seen across investment grade to high yield, to the leveraged loan market, to the CLO market has been really quite staggering, especially considering that borrowing costs are still pretty high all in.
How does the equity market play into their decision to do new issuance?
So the equity market, when it comes to net financing, so if you are a company that wants to buy another company and you have strong equity valuations, then you can use your stock as partial currency to pay for a big deal rather than just using entirely cash or issuing new debts. And there's also just better momentum or risk sentiment when the equity market is strong. If you're a management team and your equity share price is very, very low, that's usually when you're trying to explore strategic alternatives and trying to figure out what the heck am I going to do with my company to maintain or preserve some sort of equity value. But if I'm a company that's trading at, very high multiples and have good currency within the equity market, then I probably have the power to go out and do some interesting M&A that's going to expand my operational scale or diversify my product lines. That's very much consistent with what we might start to see over the next few months or so. And in some sectors like energy, which has performed really well, we've seen a lot more of M&A over the past 18 months or so, because that was one of the places that the equity market was really outperforming in 2022. And so bankers would go to their energy companies and say, hey, you have a good thing going for you, and we can help you make it even better. Look at this company you should buy.
So that's interesting. So a company's strong stock price is kind of a de facto kind of credit rating or credit guide, if you will, for fixed income markets. Or can be.
Yeah, it definitely helps to have good equity valuation behind whatever debt you have in your capital structure. If you're a 6 times leveraged company, that's a lot of leverage. But if your enterprise value is 22 times, then you have an awful lot of equity value kind of supporting the valuation of the bonds.
Do you have a sense of the buyers outside of channels, but regional basis, if you will, for U.S. corporate debt? Is there a large international component?
There is a very large international component, and we actually updated our chart today that looks at the holders of corporate debt. And international is actually the single largest cohort of owners of U.S. corporate debt, about 20 or 25 to 35%, kind of depending on where you are in the cycle, is owned by non-U.S. investors. And within that paradigm, there's, insurance companies and asset managers and private wealth and a broad spectrum of different investor types. But when we just lump everything non-U.S., they are top of the list.
And so kind of with that in mind, and then I'm thinking about our sovereign credit rating for the U.S. as well, and given the level of the federal balance sheet, could corporate credits be better than the U.S. government at some point in some sectors?
Well, there have been periods of time in the past where very highly rated corporates have traded at negative spreads, which would imply that those corporates were viewed as more sound than the U.S. government. Now, I don't know that investors historically were saying, oh, actually, Johnson & Johnson is just a better operator than the U.S. government. There are a lot of kind of technical factors that will sometimes impact valuations. And I think there's definitely a knee-jerk reaction lately to look at the kind of mess of large fiscal deficits and massive treasury funding needs and concern around kind of faith in institutions and how does this whole thing end up playing out? What does it mean for treasury yields? And say, okay, maybe I should be buying all the Apple bonds because I think they're going to be doing okay and maybe spreads will be negative. But the reality of it all is that the US dollar is still the reserve currency, and the US dollar and treasury market are still just vital to the global financial system. So if something were to go truly sideways, if we were to somehow have the US credit rating get downgraded to, triple B, which would be kind of the cusp between investment grade and high yield, then I don't know that people would be all that excited about US corporates because they would have these massive other issues to be contending with that would indicate that perhaps the US dollar is no longer the reserve currency. The reality is also US corporations don't have the power to tax and spend. As much as a new iPhone feels like a tax because we just have to buy them as soon as they come out, we still have free will. We won't go to jail if we don't buy a new iPhone. Whereas if you don't pay your taxes, then there is a repercussion for that. And the US government can kind of recalibrate what tax rates are going to be. I think that there are some interesting structural considerations underpinning very tight valuations for the highest rated corporates. It's a much smaller share of the investment grade market than it was historically. And so I think that there's an argument to be made that that scarcity factor is going to keep spreads very tight for AAA and AA corporates. And there's also a limit on where spreads can go wider if we have higher yields. So the higher yields go, the kind of less incremental spread you need to have for these very highly rated issuers, because it means that dollar prices are very low. So if I can buy Apple bonds for 50 cents on the dollar, that feels like a pretty good opportunity, even if spreads are very tight.
So it sounded like you're not too concerned generally about the leverage positioning of the underlying issuers. So, I mean, did you have an outlook on potential for fallen angels or the high yield market?
Yeah, absolutely. So the high yield market of today is not the high yield market of the 1980s or 90s or even the pre-GFC 2000s. It looks in aggregate a lot more like kind of investment grade light. And the big thing differentiating a lot of high yield issuers, especially that are rated BB, from investment grade is size and scale of operations. Ratings agencies in general have a bias towards bigger companies are investment grade, smaller companies are high yield. And there's some kind of gray area in between those things. We've had plenty of very large fallen angel companies, like Kraft Heinz was a big one, Ford was a big one. But in general, the biggest differentiator for, in a lot of cases, is just kind of size and scale of a company. When we think about the rating cycle, we've had a pretty significant upgrade cycle since March of 2020. The ratings agencies were very preemptive in downgrading both within investment grade and then within high yield and from investment grade to high yield on the expectation of a pretty significant economic rollover with the pandemic. And since then, a lot of those companies that were downgraded in the consumer space, a lot of the cruise lines and the airlines, or Ford was one of them, or energy companies, they've all been making their way back up the rating spectrum. And we think that that upgrade momentum is probably going to slow down. And at this point, there are still more potential rising star companies when you just kind of look at the number of them, but they have a lot less debt outstanding. Whereas there's a relatively small handful of fallen angel companies that our analysts are very focused on, about 9 or 10 of them, but they have massive capital structures. And so you have this kind of lopsided mismatch between number of companies and the actual amount of debt outstanding. So the fallen angel list, while it may be short, it definitely has the potential to be a significant impact to the high yield market. Now, the good news is the high yield market has been shrinking over the past few years because of a lot of these rising star upgrades that have already materialized, and also just kind of a lack of net new issue supply. We're not seeing M&A, not seeing LBOs, just kind of refinancing activity. That means there's not a lot of new money that needs to be put to work. So some high yield investors are kind of excited about the prospect of some of these fallen angels coming their way because they can put cash to work in companies that are still fundamentally sound, just perhaps not investment grade rated companies.
Are there sectors that people might be surprised that you're interested in? Like, is there a sector that you're just licking your chops and go, it's sold off, I would start hunting in this area?
Probably utilities is one of them in the investment grade world. It has definitely sold off. It's definitely trading wide of where it has historically. And if we get any relief on the rate side of things and the cost to borrow, that will be a very helpful thing for utilities. And I guess kind of the little sneaky thing about technology and the AI revolution is it's very energy intensive. And so if you think about the energy intensity and then think, okay, well, who's going to really benefit from a massive demand for electricity? That is the utility space.
Yeah, I saw in your background, did you trade energy in the past, or you did something in the energy market, right?
Yeah. So when I started my career, I was working in investment banking. So I was in the energy and power group looking at all of the regulated utilities and some of the independent power providers, energy LLPs, and helping those companies manage their capital structures, do M&A, all of those things.
Yeah, that's fantastic. Yeah, I was thinking about that, AI and then the impact on energy, and I was going to ask you that later to see what you thought, but thank you very much for that.
You're welcome.
One of the other big trends over the last few years has been private credit. What has been the impact on the public markets? And do you think that trend will continue?
Sure. So it's had a few different impacts on the public markets. The top of mind one from talking to a lot of public credit fund managers is it's been a source of tremendous competition and competition for new dollars to invest. And so the public high yield bond managers have always viewed private credit as a little bit of a skeptical, this feels too good to be true type thing, because they're competing directly for those assets to invest. Now, taking a step beyond that, private credit for much of 22 and 2023 was an absolutely crucial source of liquidity for the leveraged finance markets, especially when we think about broadly syndicated loans and some of the concerns that people had around, oh my gosh, the loan market has a much shorter kind of term structure of maturities. And there's a lot of refinancing that's going to need to get done for some of these credits that are just a little bit hairy. They're a little bit stressed, and we're not sure that investors are going to be super keen on rolling over those capital structures or putting new money in. And private credit came in and really stepped up to provide some cash to limit default losses across high yield and leveraged loans. Now, going forward, private credit, I think, is going to be a little bit more difficult to sustain from an outperformance perspective. It has outperformed the high yield bond market quite handily in most years, really since kind of the private credit inception. But the cycle of the past few years has been very unusual, right? We've had a cycle where liquidity and duration were the absolute worst things to have in your portfolio. If you owned treasuries, if you owned US investment grade, you were down 12% in 2022, whereas private credit was up. There's no liquidity, there's no duration. It's just all kind of steady Eddie as it continues to kick off whatever coupon, and there was no real maturity risk and no mark-to-market risk. Hopefully, that is not just the norm going forward, right? If investment grade is up and down 12% every year going forward, I think I'm going to have to find a new career because that is far too stressful for my taste. I guess I'll have to just go into private credit. now we are starting to see this strong track record of private credit, and the reopening of the public markets is resulting in a lot of competition across the private and public markets. And we're starting to see a little bit of loosening in private credit underwriting standards and covenants. And part of the whole marketing pitch was private credit, we have better covenants, we have better underwriting, you're the only lender, you're going to know exactly what's happening with the company at all times. And that seems to start to be on the course to not be quite as strong of a pitch. One other thing that we've seen is that a lot of the private credit companies are somehow private equity sponsor backed. And sponsors through the cycle have been very happy to say, oh, you know what? This portfolio company is just going through a hard time, but we see the bridge to the other side, and we're happy to inject another 100 million, 250 million, whatever that liquidity need was to get them to the other side. And that appetite also seems to be changing a bit. And so private credit, I think, has been really good. I think that there's still going to be good returns going forward, but I don't think it's going to be the massive outperformer and just kind of rock solid asset class for the next 5 years that it has been for the past 5 years.
And then maybe this goes to your outlook for what the Fed does if you maintain one, but fixed or floating rates and fixed income today.
Yeah, so I think that this also really depends on where you're looking, fixed or floating. Are you looking at floating rate investment grade, like the CLO AAA tranches, or are you looking at broadly syndicated loans? Are you looking at private credit? Because you have to get both the duration call right, you have to get the Fed call right, and then you have to get the recession credit risk call right. And so we've been heading into this year more constructive on fixed over floating. That's been painful to start the year as we've seen a repricing of Fed expectations, and some of the economic data have come in hotter than we anticipated to start the year. The reality is that base rates, so the Treasury rate, the underlying SOFR rate, when we look at broadly syndicated loans, that represents a very large chunk of yields across both markets. And you have to have a pretty high conviction view that rates are going to stay at current levels or even move higher to prefer floating over fixed going forward. Now, it's a reasonable view to have, but then we also have to make the next step of the analysis and say, okay, if rates are going to remain elevated, then we're going to have a much bigger negative impact on credit fundamentals for lower rated floating rate issuers, the leveraged loan market issuers, because borrowing costs are going to be very high. And we've already had the period of time where people are kind of willing to give some of these companies a pass in terms of interest coverage, or the ratings agencies are willing to say, well, we rate through the cycle, so we don't need to do downgrades quite yet because we're not through the cycle. But in another 12 months, that might not be kind of the narrative anymore. So I've preferred fixed. I've been buying fixed in my own personal portfolio, so I'm definitely talking my own book here.
You out in the duration curve or maturity curve? Or
Yes, I've been buying some TLT. I still have a pretty solid chunk of T-bills as well that I've just been reinvesting over and over again. So I'm definitely playing the barbell strategy.
Which seems like a prudent approach, I think. It's things are uncertain, do a little bit of each and
Yeah.
cover your bets.
Yeah, when in doubt, barbell. It's how I order at restaurants, salad and French fries, barbell strategy there, barbell in my portfolio.
Fantastic. Maybe you could tell me a little bit about CreditSights, give you a chance to talk about that and what you do there.
So CreditSights is an independent credit market research shop. So we are focused on the corporate bond markets, investment grade, down to high yield, and the loan market, really around the globe. We have 100 research analysts based in the US, Europe, and Asia, looking from the bottoms up at individual issuers and sectors. And having that robust analyst team makes my job as a strategist so much more interesting, and I think much more impactful, because one of the reasons that we got some of our recent calls right was we would go to our analysts and say, hey, everyone's really worried about this consumer recession. What are you seeing? And our cruise guy would say, well, forward bookings are unlike anything we've seen before. So there's no recession here. And that would really help us kind of shape our views. Beyond the fundamental research, CreditSights also has some companies within its portfolio covenant review, which is a deep dive into all things covenants, and staffed by a team of lawyers, most of whom worked with a number of the big law firms that help structure these deals. We have Levfin Insights, which is a news organization devoted to the leveraged finance markets. And then we have Bixby, which is a leveraged loan market data provider. And so I have the benefit of having those resources as well. And we just continue to expand coverage into loans, into private credit, and into special situations.
Well, this is great. Let's see, as we start to kind of close it out and just kind of leave people with some things to think about in terms of making an investment in corporate bonds, what do you think some of the top factors to consider are?
Sure. So I think that when we think about corporate bonds, the fundamentals always matter. You want to make sure that you are buying a company that you feel good about its cash flows today, its potential cash flow. How much are they generating? Are they spending it wisely? Is cash flow negative? If so, does management have a plan and a reasonable time frame to move into positive cash flow territory? That goes also with liquidity. Does the company have cash on hand? Do they have access to the capital markets, be it short-term with revolver drawings or commercial paper, or ability to do a new deal in the bond market? If it's a publicly traded, what does the equity market look like? If equity prices have not been so good, that's probably something that you should be definitely aware of as a bond investor. Another thing that's really important is the management team. Do they have a track record of supporting bond investors and equity investors alike? Do they historically do what they say they're going to do, especially as it relates to leverage targets and maintaining or improving ratings? And then also understanding, are we in a sector where there are secular structural headwinds, right? A lot of bonds are very long dated. If you're buying a 30-year bond in a sector that may or may not exist in 30 years, that might prove to be a problem.
And maybe we should just read your research. A lot of factors there.
That would be great. I think that reading the CreditSights research, I always learn a lot. So I recommend it to all my friends. Nobody in the neighborhood mom's book group has, adopted CreditSights research as our pick for the month, but I'll keep pitching it.
Awesome. Great. So let me, as we start to close out, I ask this question, which is, what's one long-term trend you see playing out over the next year or several years? It could be about what we just talked about, or it could be about anything else that's top of mind.
All right. I'm going to go totally rogue.
Oh, all right.
And one of my favorite things to learn about and watch and listen to is distance running in the US. And there has been a massive rise in the dominance of US women's distance running. And the marathon, I think, in Paris this year is going to be really exciting. And I'm definitely rooting for some of our women to bring home a medal. Oftentimes, the women in the US are kind of viewed as the underdogs relative to some of the African country powerhouses. Kenya and Ethiopia just produce amazing runners. But I think that US women's distance running is a super exciting place to be right now. And from an economic perspective, there's been a very significant increase in runners in kind of the post-COVID era. You look at, the London Marathon applicants, it's harder to get into the London Marathon than it is to get into Harvard. And a lot of those people are buying shoes and, looking at the faces who represent the brands. And so I think that having really strong American women representing some of these brands is just a really cool intersection between women's sports and the economy, and just so exciting to watch.
Oh, that's fantastic. That was a great answer. I love running. I haven't run in a couple of years because I was doing some half marathons, a couple marathons, but I really got into it for a while and I need to get back to it. I take it you are a runner.
I do run, not particularly fast, but I love it. It's just such a nice time to be with yourself, or be with a podcast, or be with friends. I love that the US is kind of reinventing itself as it relates to running.
Fantastic. Well, I'm going to look out for that now. That's cool. All right. How about trend or fad? I'll ask you about a few different topics, get your quick take. Sometimes these are funny, sometimes these are stupid, but it's a good way to.
I'm excited to see what this is.
CLOs, trend or fad?
Oh, CLOs are definitely a trend. They are here to stay. I have a good friend who's a CLO strategist, and I probably send him a news article once a week saying, is your asset class finally taking down the global financial system? And it hasn't yet. And so I'm definitely sticking with trend.
Cat bond issuance, trend or fad?
That is probably also a trend, unfortunately.
AI, trend or fad?
So I think that this is one that is a little bit of both. I think it might have turned a little bit fatty in the short term, as most technological progress always goes through these periods of overhype and then a pullback. But I do think over the medium to long term, trend for sure.
This is kind of a funny one. Our intern found this one. Emotional support water bottles. Have you heard of that?
I have heard of that. I have a 9-year-old daughter, and just watching all of the little elementary schoolers walk out with their massive Stanleys, most of which the Stanley weighs more than they do. Emotional support water bottles seem to be a trend from looking at the youth.
Well, speaking of youth and young ones, how about DINK consumers? Dual income, no kids.
I'm mostly just jealous of them. I don't know what that means.
What is life like that way?
I know, right?
Well, I can tell you it's awesome. And then because you're a pet owner as well, and we've really gotten into this lately, human grade dog food, trend or fad?
I wish it were a fad, but it's probably a trend.
Well, this is awesome. Thank you very much, Winnie. Appreciate your time. What is the best way for people to learn more about you, what you're doing, or maybe check out CreditSights?
Sure. So you can always go to CreditSights.com and check out the offerings we have on our website. And I also have a podcast that you can listen to on any of the podcast hosts.
Fantastic. It's great. I caught a couple episodes, learning a lot.
Thank you.
And thank you for tuning into this episode of Trends with Benefits.